Right now, something fundamental is breaking beneath the surface of the global economy, and most people can feel it, even if they cannot yet explain it. Prices are rising faster than wages, savings feel weaker every month, and the cost of simply standing still keeps climbing. Groceries, housing, insurance, energy, everything inches higher in a way that feels relentless rather than chaotic. And yet at the same time, asset prices remain elevated, debt keeps expanding, and those who already own capital appear oddly insulated. This is not coincidence, and it is not a temporary distortion. It is the visible symptom of a deeper mechanism at work. Inflation is often explained as a mistake, a shock, or an unfortunate side effect of crisis management. But that explanation no longer holds. What we are witnessing is inflation functioning exactly as designed inside a debt-driven system. Here is the uncomfortable truth. Inflation does not simply make everyone poorer equally. It redistributes purchasing power upward. It quietly transfers value from people who rely on wages and cash savings toward those who control assets and leverage. This is why two people can live through the same inflationary period and experience completely opposite outcomes. One feels squeezed and anxious, the other feels wealthier without changing behavior. The core question is not why inflation happens. The real question is why it keeps being allowed to return again and again, even after decades of warnings. To answer that, we need to stop treating inflation as an accident and start understanding it as a structural feature. Modern economies are built on expanding credit, not on accumulated savings. That single design choice changes everything. In a credit-based system, money must lose value over time, or the system locks up under the weight of its own debt. Inflation becomes the release valve. Without it, defaults cascade, asset prices collapse, and political stability fractures. With it, the burden shifts quietly. People blame corporations, supply chains, or policymakers. But the deeper force is arithmetic. Debt demands inflation to survive. And once you see that, the rest of the story becomes much easier to understand. The gap between rich and poor is not an accident of behavior. It is the predictable outcome of a system that rewards leverage and punishes patience. And this is only the beginning of how that logic took hold. To understand how inflation transformed from a national emergency into a tolerated policy tool, we need to go back to a time when money itself was constrained. In the early 20th century, most major economies operated under some version of a gold-based monetary system. Currency issuance was limited by physical reserves, which imposed discipline whether governments liked it or not. If a state overspent, it faced immediate consequences. Taxes had to rise or spending had to fall. There was no painless escape. Inflation under that system was rare, and when it appeared, it was usually associated with war or outright mismanagement. In that era, inflation was feared because it signaled failure. But the Great Depression shattered that worldview. The crisis of the 1930s did not bring runaway inflation. It brought deflation. Prices collapsed, wages fell, and debt became crushingly expensive in real terms. People stopped spending, not because things were too expensive, but because money itself became more valuable over time. Holding cash felt safer than investing. That behavior froze economic activity. Businesses failed, banks collapsed, and unemployment surged. The system seized up not from excess, but from paralysis. Policymakers learned a brutal lesson. Absolute monetary discipline could destroy an economy under stress. Deflation made every existing debt heavier and every future investment riskier. It created a downward spiral that governments could not easily reverse. By the end of World War II, this lesson was deeply ingrained. Nations emerged victorious but buried under unprecedented levels of debt. Raising taxes further risked political backlash. Cutting spending risked recession. Something had to give. Slowly and quietly, inflation was reframed. No longer an enemy, it became a necessary compromise. A moderate, persistent rise in prices could erode the real value of debt without triggering formal default. It allowed governments to meet obligations without admitting insolvency. This shift was not ideological, it was practical. Inflation became the lesser evil compared to deflationary collapse, and once that door was opened, it never fully closed again. Money was no longer just a store of value. It became a policy instrument. Stability was redefined, not zero inflation, but manageable inflation. That redefinition set the stage for the modern monetary world. The final break with monetary restraint came not through theory, but through necessity. After decades of post-war rebuilding, the global system rested on a fragile compromise. The US dollar remained loosely tied to gold through international agreements, even as domestic credit expanded. Over time, the contradiction became impossible to hide. Government spending outpaced reserves. Dollars circulated globally, far beyond the gold backing them. Confidence began to crack. When foreign holders questioned convertibility, the system faced collapse. In 1971, the decision was made to sever the final link between money and gold. Officially, it was framed as temporary. In reality, it was permanent. From that moment on, money became fully fiat. Its value rested not on physical scarcity, but on trust in institutions. This was not just a technical adjustment, it was a transformation of incentives. Without a hard constraint, money supply could expand to accommodate political and financial needs. Debt could grow without immediate consequence. Inflation shifted from an outcome to a management variable. Central banks gained the ability to smooth crises by injecting liquidity. Governments gained flexibility to finance deficits without explicit tax hikes. Banks gained freedom to extend credit repeatedly. But this flexibility came at a cost that was not evenly distributed. When money is created without a fixed anchor, its purchasing power must adjust somewhere. That adjustment shows up as rising prices over time. Crucially, it does not hit all actors simultaneously. Those closest to credit creation benefit first. Asset prices respond before wages. Debt becomes easier to carry while savings quietly erode. This is why leverage became central to wealth accumulation after 1971. The system now rewards those who borrow to acquire assets that reprice with inflation. Meanwhile, those who save in cash or rely solely on labor income fall behind even if they behave responsibly. None of this requires conspiracy. It is the mechanical result of how fiat money operates in a credit-driven economy. Inflation is no longer a sign of failure. It is a stabilizing force that keeps the machine running. But stability for the system does not mean fairness for individuals. The rules changed quietly, but once they changed, they reshaped every outcome that followed. Once the monetary system detached from hard constraints, the internal logic of money quietly inverted. What had once been considered responsible behavior began to lose its protective power. Saving cash no longer preserved value over time. It merely slowed the rate of loss. In a world of persistent inflation, money sitting still becomes weaker by design. This is where the great misunderstanding begins. Most people are taught that discipline and patience are rewarded, but inside a fiat system, patience with cash is punished. Inflation steadily erodes purchasing power, turning savings into a melting asset. Meanwhile, debt behaves very differently. When prices rise year after year, the real burden of fixed debt shrinks. The nominal amount stays the same, but the economic effort required to repay it declines. This single asymmetry explains a great deal of modern wealth inequality. Those who borrow to acquire assets are aligned with the system. Those who avoid debt and rely solely on wages are not. Consider housing. A mortgage taken today may feel overwhelming, but over time, inflation lifts rents, wages, and replacement costs, while the debt itself remains fixed. The asset appreciates while the liability fades. The same logic applies to equities, businesses, and land. These assets reprice with inflation. Cash does not. This is why inflation is hostile to savers but friendly to borrowers who own productive or scarce assets. It is not about recklessness. It is about positioning. The system encourages leverage not through propaganda, but through outcomes. People observe who advances and who stagnates. Over time, behavior adapts. Debt becomes normalized. Asset ownership becomes a survival strategy rather than a luxury. This is not moral failure. It is rational response. But it comes with consequences. Those without access to cheap credit or appreciating assets find themselves trapped. Their income lags behind prices. Their savings lose value. Their caution offers no shelter. Inflation quietly transfers purchasing power from those who hold money to those who hold assets financed by debt. This transfer does not appear on any tax bill. It does not require legislation. It happens automatically, and once this mechanism is understood, it becomes clear why inflation persists. It is not merely tolerated. It is structurally necessary to sustain a system built on ever-expanding credit. Inflation does not move through society evenly. That assumption is one of the most damaging myths in modern economics. When new money enters the system, it does not arrive simultaneously in every household. It enters through specific channels, and those channels determine who benefits first. This phenomenon is known as the Cantillon effect. It explains why inflation quietly amplifies inequality, even when overall growth appears stable. New money typically enters through financial institutions, government spending programs, and capital markets. Banks receive liquidity, investors gain access to cheaper credit, asset prices respond quickly, stocks rise, real estate climbs, financial instruments reprice upward, meanwhile wages adjust slowly, contracts lag, salaries renegotiate annually, if at all. By the time higher prices reach everyday goods and services, those closest to money creation have already locked in gains. For the average worker, the sequence is reversed. Prices rise first. Income follows later or not at all. Savings lose purchasing power in the meantime. This delay is not accidental. It is structural. Inflation acts as an invisible tax that falls most heavily on those with the least flexibility. People on fixed incomes feel it immediately. Renters face rising costs without asset appreciation. Middle-income households watch expenses rise faster than paychecks. Meanwhile, asset holders experience inflation as growth. Their balance sheets expand even as purchasing power declines elsewhere. This divergence reshapes social outcomes. Wealth concentrates without explicit redistribution. Inequality widens without obvious villains. The system appears neutral while outcomes diverge dramatically. This is why debates about inflation often feel disconnected from lived experience. Official metrics may show moderate averages, but distribution tells a different story. Inflation rewards proximity to credit and punishes distance from it. Over time, this creates a feedback loop. Those who benefit gain more influence and access. Those who lose fall further behind. Inflation becomes not just an economic variable, but a sorting mechanism. It determines who advances and who stagnates. And because it operates quietly, it rarely triggers immediate resistance. The transfer happens gradually, year by year, bill by bill, until the gap becomes impossible to ignore. By then, the system has already adjusted around it. Central banks sit at the core of this dynamic, not as villains, but as stabilizers of a fragile system. Their primary mandate is to prevent collapse. When crises hit, they act quickly to restore liquidity and confidence. The tools are familiar: lower interest rates, asset purchases, emergency lending facilities. Each intervention is justified as temporary. Each one leaves a lasting imprint. By injecting money into financial markets, central banks prevent deflationary spirals. But they also inflate asset prices. This is not an unintended side effect. It is the transmission mechanism. Stabilizing the system requires supporting asset values because those assets anchor debt, pensions, and institutional balance sheets. When markets fall too far, the system risks cascading failure, so liquidity flows toward assets first. The result is predictable. Asset holders recover quickly. Those without assets do not. After the global financial crisis, massive monetary expansion restored stock prices within years while wages stagnated. After the pandemic shock, unprecedented stimulus pushed markets to new highs even as living costs surged. Each cycle reinforces the same pattern. Intervention prevents collapse but deepens inequality. Inflation remains contained in consumer prices for a time while asset inflation accelerates. Eventually the pressure spills over. Costs rise, purchasing power falls. Central banks then face a dilemma: tighten policy and risk recession, or tolerate inflation and preserve stability. In practice, they oscillate. They signal restraint while maintaining flexibility. Their true objective is not zero inflation, it is system continuity. This is why inflation rarely returns to zero for long. A small, steady erosion of money value is easier to manage than sudden deflation. It keeps debts serviceable. It keeps markets functioning. It keeps confidence intact. But it also locks in a hierarchy of advantage. Those positioned inside the financial system benefit from protection. Those outside absorb the cost. This is not conspiracy, it is consequence. A system designed to survive will prioritize its own stability over equal outcomes, and inflation is the price paid for that survival. As inflation persists, its most powerful effect may not be economic at all, but psychological. Over time, it reshapes behavior in ways that reinforce the very system causing the strain. When people learn that money loses value by waiting, patience stops making sense. Spending now feels safer than planning later. Saving feels pointless unless it can be converted into something that rises with prices. This is how inflation quietly trains an entire population. It rewards speed over caution and leverage over restraint. People begin to chase returns not because they are reckless, but because standing still guarantees loss. This shift changes how households think about risk. Debt becomes normalized. Long-term obligations feel manageable as long as prices keep rising. Asset speculation starts to look like prudence rather than gambling. Even those who understand the danger feel forced to participate. The system leaves little room for neutrality. You either own assets that inflate or you fall behind. This is how inflation becomes cultural. It alters values without explicit instruction. Financial anxiety turns into constant motion. Buy now before prices rise again. Invest now before access disappears. Borrow now while credit is still cheap. These behaviors feed back into the system, driving demand, pushing asset prices higher, and reinforcing inflationary pressures. The loop sustains itself. Meanwhile, inequality hardens into identity. Those who benefited early see inflation as manageable or even helpful. Those who did not experience it as suffocating. Dialogue breaks down because lived realities diverge. One group discusses portfolios, the other discusses survival. Inflation widens not just wealth gaps, but perception gaps. It creates parallel worlds inside the same economy. Over time, this erodes trust. People lose faith not only in institutions, but in the idea that effort leads to progress. Productivity no longer feels rewarded. Speculation feels necessary. This is a dangerous transition. Economies can tolerate inflation longer than they can tolerate hopelessness. When enough people believe the game is unwinnable, social stability weakens. Inflation is not just a financial variable, it is a behavioral force that reshapes incentives, expectations, and ultimately legitimacy. Understanding this dimension is essential to grasping where the system may be heading next. At its core, inflation is not a flaw, but a fuel. It is the oxygen that allows a debt-based system to keep breathing. Without it, obligations become unbearable, defaults spread, and the structure collapses under its own weight. With it, the system survives, but at a cost that is quietly distributed downward. This is the moral tension embedded in modern economics: stability for the system versus security for the individual. Inflation resolves that tension by choosing continuity over fairness. It keeps governments solvent, banks liquid, and markets functioning. It does so by slowly transferring purchasing power away from those least able to defend it. This is why inflation is rarely eliminated. It is managed. Suppressed here, allowed there, adjusted, but never destroyed. Zero inflation would freeze credit expansion. Deflation would expose every weakness at once. A controlled loss of value is the compromise. The result is a world where wealth increasingly flows to those who already possess assets and leverage, while labor alone struggles to keep pace. This does not mean outcomes are predetermined for every individual. It does mean the rules are tilted. Understanding those rules matters. Not to game the system recklessly, but to see reality clearly. Inflation is not caused by greed alone. It is sustained by structure. It is not temporary noise. It is a recurring feature of how modern economies finance promises today with resources from tomorrow. Once you see that, the question changes. It is no longer why prices keep rising. It becomes where you stand when they do. Are you positioned where inflation works for you or against you? Are you insulated by assets or exposed through income alone? And perhaps the most uncomfortable question of all is whether a system that depends on silent erosion can remain legitimate indefinitely. Let me know what you think in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.